Right. Good evening, students. I think I'm audible enough and you can see my screen. Can you see my screen as well? Okay, thank you very much. Right. Good evening again. We'll start the lecture. Today we are going to discuss actually two lessons. I have uploaded the slides to LMS. Uh, the first lesson I'm going to talk about is audit materiality. So as you can see, it is again a very important auditing standard. We call it ISA 320, materiality in planning and performing audit. So basically, we are talking about auditing materiality, right? Materiality. Now we'll see, first of all, is every error in financial statements important to auditors? What do you think? There can be now, when as auditors, when we are auditing the financial statements of a client, there can be errors, there can be omissions, there can be misstatements in the financial statements. So my problem is every error in financial statements important to auditors? So auditors do not aim to detect every single error, that you know, right? Because when we are doing the audit, we do it on sample basis. So in that case, it's not very important, or it's not that essential that we find out, that we identify all the errors in the financial statements, because that is not practically possible. We do the audit based on sample basis. So auditors do not aim to detect every single error. Instead, they aim to obtain reasonable assurance. I have explained you that when it comes to external audits, financial statement audits, we are giving reasonable assurance that the financial statements are free from material misstatements. So, a misstatement is material when it could reasonably be expected to influence the decisions of the users of the financial statements. So, if you can remember, when I was talking about, give me a second. When I was talking about the misstatements, it is always we say material. We always say financial statements free from material misstatements, not just misstatements, right? So when we are giving the assurance to our client and the shareholders or any other party, we are saying that the audited financial statements are free from not all the misstatements, from material misstatements. So that is the important thing. That is the important word, materiality, material misstatements. So how this materiality works? What do you mean by material misstatements? A misstatement is material when it could reasonably be expected to influence the decisions of the users. If that misstatement is influential or expected to influence the decisions of the users of the financial statements, that misstatement becomes material. Let's say when it comes to revenue, the total revenue figure of that one particular company can be 10 million. 10 million. Total is 10 million. When you audit, you find an error, that there is a very small error in one invoice that you have selected for the sample. That is, there's a difference between, there's a misstatement, let's say 10,000 rupees. There's a 10,000 rupees misstatement, but the total revenue figure is 10 million. What do you think? That 10,000 rupees, it's obviously a misstatement. That can be an error, that can be an issue. That's a misstatement. What do you think? Is that misstatement material to the financial statements? Is that misstatement material to the users of the financial statements? Not really, because that is not adequate. That is not adequate enough to influence the decisions of the users of financial statements. It is not material. So that is what materiality means. So materiality is judged in light of the surrounding circumstances and depends on size, based on the size of the misstatement, maybe the amount and the nature of the amount. Sometimes, even though the amount is lower, amount can be 1,000 or 10,000, but the nature of the misstatement is material. I have shared this example with you. If we take legal expenses, sometimes, even though there can be a small error, let's say total legal charges is 100,000. You find out an error with 2,000 rupees. One can say out of 100,000, 2,000 would be very small. That is immaterial. But the nature of the expense is legal expense, that the nature itself is material. So sometimes because of the size, that is the amount, and then the nature, or a combination of both can lead to materiality. So when we are judging whether this misstatement is material or not, size can matter, nature can matter, or combination of both. So it's always materiality is judgmental. It's always judgmental because you need to decide whether this misstatement is material, whether this is material or not. So obviously you will learn there can be different benchmarks, there can be different computations we use to calculate materiality. But getting that amount, deciding whether something is material or not, it's always judgmental. So it is assessed with reference to the users as a group, not to one unusual individual user. Something can be material not for a party, not for a specific one party, that is for a users as a group. Overall, whether this is material or not, that is what we are deciding. Right. So materiality in the context of an audit. Now we are talking about audit materiality, judgments about matters that are material to the users of the financial statements. Remember, judgmental. Always materiality is judgmental. Are based on a consideration of the common financial information needs of users as a group. Always remember, we talk about materiality not for one person, not for a particular party, but for the overall group. Misstatements, including omissions, are considered to be material because something can be material if they individually or in the aggregate. What do you mean by that? Individually, something can be taken, a misstatement can be taken individually, or there can be 5 to 6 misstatements. Sometimes not individually they are material, but when we take them together, for all 5 to 6 misstatements together, that can be material. Individually immaterial, in aggregate material. Some misstatements are there, individually also material. Right? That is why we say individually or in aggregate could reasonably be expected to influence the economic decisions of the users taken on the basis of financial statements. So basically, a misstatement can be material individually or in aggregate as well. So judgments about materiality are made in light of surrounding circumstances, as I mentioned earlier, based on the size, based on the nature, or in combination. So those are the important points in this slide. Now, when it comes to materiality, the concept of materiality is applied by the auditor both in planning and performing the audit. Basically, when we are planning the audit, when at the initial stages, as auditors, we need to calculate materiality. So it's one of the very important thing we have to do in the very beginning. Actually, without materiality calculation, we can't conduct the audit because we can't identify misstatements, whether we find material misstatements or not, if we are not having the materiality with our hands. So in that case, planning stage materiality calculation is very important. So applied by the auditor both in planning. And also, when performing the audit, that is important. When performing the audit, we identify when we are evaluating evidences, when we find an misstatement, whether that misstatement is material or not, we need the materiality calculation. So at the planning stage and performing the audit and evaluating the effects of identified misstatements, those are the three important areas, three important instances where we need the materiality: planning, performing the audit, and evaluating the effect of identified misstatements on the audit, of uncorrected misstatements, if any, on the financial statements. So basically, from the start, from the very beginning, that means the planning, what is the end of the auditing process? Giving the audit opinion through the audit report. From the very beginning till the very end of the audit, materiality is important. We use that materiality. And another important thing. Now, we will be talking about two materialities actually. One is materiality, second one is performance materiality. Now, if you are working in the auditing sector, you might know we have one amount identified as the materiality, and we have another amount identified as performance materiality. Those are two different things. We need to understand the difference between two. So, what is performance materiality? Performance materiality means the amount or amounts. It can be one amount or it can be multiple amounts as well. Amount or amounts set by the auditor at less than materiality for the financial statements as a whole. To reduce to an appropriately low level the probability that the aggregate of uncorrected and undetected misstatements exceeds the materiality for the financial statements as a whole. It's something like this. When it comes to an audit, auditor calculates materiality. There are different ways to calculate materiality, but just remember, auditor calculates materiality. That is the first thing. After calculating materiality, actually that materiality, that amount is applicable for the whole set of financial statements. So that is for the whole financial statements. Materiality, one big number. After calculating that materiality, auditor is calculating a lower amount, a lower value called performance materiality, because we are setting a higher number as the materiality, that is the maximum level we can go. But if we have only the materiality, that bigger number, when we identify the misstatements, the probability that the aggregate of those misstatements, uncorrected and undetected misstatements, can probably exceed that higher level. To reduce that risk, we are calculating very small values as well. So when we are basically planning the audit, evaluating evidences, evaluating the misstatements, we set for our purposes a smaller level, a lower level of materiality. So, how do we calculate? How do we use this materiality basically? Let's say we set the overall materiality of our organization as 1 million. 1 million. Now, what do you mean by this 1 million? When we find out misstatements, if that misstatement is lower than the materiality, that means 1 million lower than means, let's say 500,000. Is that material? Is that misstatement material? No, because it is less than the materiality level. In that case, 500,000 is immaterial. We are not going after that issue. Let's say we are finding out a misstatement that value is 2 million. Our materiality level is 1 million, whereas we have find out a misstatement equal to 2 million rupees. Is that misstatement material or not? Obviously material. So that value, that misstatement is a material misstatement. That is how we basically identify material and immaterial misstatements. So let's say if we always use that 1 million benchmark for the whole audit, what will happen? So so far we have ignored one misstatement called 500,000 because that was below 1 million. 500,000 was the issue misstatement. So we just ignored it. The reason is that misstatement is immaterial, below the material level. What if we find another issue? And that is 200,000, again immaterial. So we are ignoring that issue as well. What if we find another issue that is 300,000? Again, that is immaterial, below 1 million rupees. We are ignoring that issue as well. So, likewise, if we do so, we won't be able to survive, right? We won't be able to find out the issues. So, that is why at the end of the day, when we take all these, the aggregate or the total value of these uncorrected and undetected misstatements, 500,000 plus 300,000 plus 200,000, likewise, it will go. So we are really at a risk if we always consider the higher level materiality and ignore all those smaller values below the materiality, the aggregate, the total will be ultimately higher than the overall materiality. So we can't tolerate that issue, that risk. That is why we are calculating a lower value for our purposes, which is called performance materiality. Let's say overall materiality is 1 million, but for performance materiality, we calculate 200,000. So when we have the performance materiality as 200,000, we are going to check all the misstatements above 200,000 as material. So we are not just ignoring, saying that it is lower than materiality. We set a lower value as 200,000. So in that case, 500,000 misstatement, that 300,000 misstatement, even that 200,000 misstatement, we are finding, we are searching, we are investigating further to find out whether this has an effect on the financial statements. So I hope that's clear. So always higher level is materiality, and below that total higher level materiality, we calculate something called performance materiality. Right? So, if applicable, performance materiality also refers to the amount or amounts set by the auditor at less than the materiality level. Remember, sometimes I told you there can be different amounts as well, no? One performance materiality or multiple performance materiality levels. Sometimes, if the organization is very large, we tend to calculate materiality levels for different transactions, account balances. Basically, for PPE, if that PPE subsection is very risky, I would say we will be calculating a separate amount as performance materiality. For revenue, we will be using another one. Give me a second. Right? So we will be calculating performance materiality for different classes of transactions, different account balances. For PPE, this is the materiality. Anything above this amount would be material. That is 200,000, I would say. For revenue, we said performance materiality is 50,000. Anything above, any misstatement above 50,000, we consider as material. So we tend to investigate on those factors. Likewise, some organizations actually they calculate performance materiality levels for different balances and transactions. So sometimes it can be only one level as well. Right. And then the next one is determining materiality and performance materiality when planning the audit. Basically, we calculate this materiality not towards the end of the audit, definitely at the very beginning. When establishing the overall auditing strategy, the auditor shall determine materiality for the financial statements as a whole. So we need to calculate materiality at the very beginning. If in the specific circumstances of the entity, there is one or more particular classes of transactions, account balances, or disclosures for which misstatements of lesser amounts than materiality for the financial statements as a whole could reasonably be expected to influence the economic decisions of the users taken on the basis of financial statements. That means if we take the overall financial statements, if one particular section, let's say PPE, is very, very important in that company, let's say it's an investment property company. In that case, investment properties are very important. Let's say it's a contract construction company. In that case, revenue is very significant, very tricky. So sometimes some sections are very, very important based on the nature of the industry. So likewise, if you have such important captions in the parked in your financial statements, we tend to calculate performance materiality levels for those captions. That is what I was talking about. So determine the materiality levels or levels as applied to be applied to those particular classes of transactions. So in addition to materiality, they calculate several performance materiality levels. And then revision as the audit progresses. What do you mean by that? Now I told you basically we calculate materiality at the very beginning. But don't think that we are going to stuck with one amount throughout the audit. When we go alone, as I have mentioned earlier, we tend to change our auditing strategy. We tend to change our audit plan. When we go along the auditing process, we might find different issues, control deficiencies, misstatements, frauds, errors. When we go along the auditing process, at the very beginning, we didn't know that there were things like that. So, auditor shall revise materiality for the financial statements as a whole in the event of becoming aware of information during the audit that would have caused the auditor to have determined a different amount. If you want to change it based on the initial figures that we were not aware of such conditions. But if the auditor is getting aware of different conditions that will lead to change the materiality during the audit, auditor can obviously change materiality. So that is what we identify as revising materiality. We can revise materiality. Right. And then use of benchmarks in determining materiality for the financial statements as a whole. Now, I told you when we are calculating materiality, there can be different benchmarks. There can be different ways we calculate materiality. So, how do we do that? First of all, I told you determining materiality involves the existence of professional judgment. It's always a professional judgment, calculation of materiality. How do we calculate? Basically, it's kind of a percentage. A percentage is often applied to a chosen benchmark. We select a benchmark. That benchmark can be profit before tax, total assets, revenue, equity. Likewise, we select benchmarks. Based on that benchmark, we apply a percentage. So that is how basically we calculate materiality. That is a starting point. The elements of the financial statement, sometimes we take total assets, total liability, equity, revenue, expenses. But most of the time it can be profit before tax, total assets, total revenue, total expenses. Likewise, there can be different benchmarks based on the industry, based on the circumstance, based on the nature. We might select the benchmark. Whether there are items on which the attention of the users of the particular entity's financial statements tend to be focused. So, for an example, for the purpose of evaluating financial performance, users may tend to focus on profit, revenue, or net assets. So, if it is a profit-oriented company, the auditors might select profit before tax. If it is an asset-based company, if the assets are very important in that financial statement set, company will select total assets as the benchmark. So it's a different story. Selecting the benchmark, again, a professional judgment. Anyway, you select the benchmark and you apply the percentage. That's how you calculate materiality. Sorry. And then factors affecting judgment. So I told you materiality is a judgment. What are the factors affecting judgment? So materiality is a relative rather than an absolute concept. It's not a absolute concept, I would say. It's always relative. Selecting the benchmark is relative, and always selecting the percentage is relatively important. That is again professional judgmental. And bases are need for evaluating materiality. Base, selecting the base means the benchmark. And then always there can be qualitative factors affecting the materiality as well. So, what are the qualitative factors affecting materiality? Consideration that may render material a quantitatively small misstatement. Basically, that in amount as an amount that is immaterial. When you calculate materiality and performance materiality, this amount is very immaterial. But if it is something related to a loan covenants, what do you mean by loan covenants? When the banks and the financial statements are giving you loans, they set different criteria to be met by all the companies. Let's say if you want to have this loan agreement with us, you need to maintain 5% gross profit margin every year. It's a loan covenant. So that one, even though the amounts can be smaller or immaterial, loan covenant is material itself by nature. It's a qualitative treatment. Changing trend, management compensation, financial statement uses, or concedes an illegal act, something related to legal aspects. Some qualitative aspects can be there likewise to decide something is material or not. So remember, always the amount can be material and also the nature. Qualitative factors also can affect the materiality. And then another important thing, materiality and audit risk. What do you think about that? Actually, there's a relationship between these. If materiality is set lower, that means the amount we select as the materiality level. Let's say instead of 1 million, we select the materiality level as 500,000, half of it. So materiality is set lower. The auditor usually needs more persuasive evidence and more extensive procedures because smaller misstatements now matter. If we select 1 million as the materiality, we are not going after 800,000 rupees misstatements, 900,000 rupees misstatements, 100,000 rupees misstatements. We select and we take above 1 million misstatements seriously. But if we have a lower material level, let's say 500,000, then all 500,000, 550, 600, 700, 800, all the statements are getting material for us. So the auditor have to do more work, more extensive procedures. We need more persuasive evidence. So a lot of work. What do you think? When the auditor works extensively, when the auditor is going after each and every small error like that, what about the audit risk? Giving an inappropriate audit opinion? The risk of giving an inappropriate audit opinion for the financial statements. The audit risk is high or lower? Anyone can answer? When we set the materiality level at a lower level, what happens to the audit risk? When we have the materiality set at a lower level, exactly, very good. Yes. I get different answers. I'm asking again. When we set the materiality level at a lower level, that means materiality level is not 1 million, we go for 500,000. If we have selected 1 million, that means we are not going after 800,000, 900,000, 700,000 issues. We are just ignoring them because those are lower the materiality level, right? So we go above 1 million issues. We don't do when you don't do an audit procedure for 800,000, 900,000 issues. But if we select a lower level of materiality, that means 500,000. If we take our materiality level as 500,000, then all the issues above 500,000 are material. Then we are going after them. We have to do more audit procedures and all. Then I'm asking, if we are doing more and more audit procedures, if we are collecting more and more audit evidence, what happens to our audit risk? Audit risk is what? Risk of giving an inappropriate audit opinion on the financial statements is high or lower. What do you think? Risk of giving an inappropriate audit opinion is high or lower? Very good, lower. Because now we don't have to worry because we have done so many work. We are collecting more and more audit evidences. In that case, risk of giving an inappropriate audit opinion is lower because we are doing work extensively. Our materiality is lower. Are you guys clear? I was explaining again and again because I got different answers. Are you okay? Are you clear? Any arguments? Good. Right. So always when the materiality is set lower, that means our audit risk is also lower. If materiality is higher, what happens? Fewer items may be significant. We are ignoring all those small issues. When we ignore all those small misstatements and issues, we might forget about. We might miss very important aspects, but we have just ignored them because they are above, not above, lower the materiality. So we have ignored most of the misstatements. So through the auditor still must remain alert to nature and circumstances. So ISO 320 connects materiality and audit risk in identifying risks, designing further procedures, and evaluating uncorrected misstatements. That means if the materiality is lower, we need to do more audit work. In that case, you can write audit risk is lower. If we set a higher level of materiality, relatively less audit work, we are not doing much work because we are ignoring most of the misstatements. We think, okay, that's fine, that's below materiality. We are not going after those small issues, but there can be a risk there. Audit risk is high. So that is the relationship between materiality and the audit risk. And then when we go along, evaluating misstatements identified during the audit. How are we going to evaluate the misstatements identified during the audit? First one is like accumulate the identified misstatements other than clearly trivial ones. You may be able to accumulate small misstatements, and then we are trying to understand whether those misstatements have an influence on the financial statements in aggregate, in total, and then communicate them to the management on a timely basis, not towards the end of the audit, but when and where you identify the misstatements, make sure you inform them on a timely basis. I would say at least weekly, right? Not daily, hourly, but at least weekly you can communicate them and request management to correct them as well and understand management's reasons. If management refuses to correct them, sometimes don't expect the management to correct all the misstatements when you explain them, when you identify them. No, they won't do it. So you understand why, what are the reasons for not correcting them. Evaluate whether uncorrected misstatements are material individually or in aggregate. Now, one important thing. So when you do the audit, let's say you identify issues, you identify errors. Maybe when you check payment vouchers, when you check schedules, when you check invoices, when you check the systems, you identify issues. Does that mean that you are going to give a bad or a negative audit opinion? No, that's not the meaning, right? When you find issues in the audit, first thing they do is client is correcting the misstatements. So that is why we say when the auditor identifies issues, misstatements, we inform them, we ask them to correct it. If they correct the issues, if they correct the misstatements, that's all right. That's fine. But we are going after what? Uncorrected misstatements. We have a problem if the management doesn't correct those misstatements. So evaluate whether uncorrected misstatements are material individually or in aggregate. Right? So communicate material uncorrected misstatements. See, sometimes we have uncorrected misstatements and they are not material enough. So we are going after what? Material uncorrected misstatements, not only uncorrected, that should be material as well. So material uncorrected misstatements to those charged with governance. That is the important thing. That should be our focus. And then what? Let's say they are not changing it, they are not correcting it. That's why they are uncorrected misstatements, right? Obtain written representations from them. What do you mean by written representations? Sometimes when we don't have evidence, when we can't do anything, we tend to get a letter kind of thing from the management in written form. That is what we call written representation, that they are aware of those kind of things. The auditors informed, and due to this reason they didn't do this. Or like, not only for these situation, let's say we are getting a written representation saying that they have done a stock count and we don't have any documents related to the stock count. Or let's say the management is saying they are taking the responsibility for this particular purpose. They will take the responsibility. They know it. Auditors have identified this issue, but they will take the responsibility. Likewise, representing them. Those are called written representations. So we can obtain a written representation from the client about these uncorrected misstatements. Why are we taking written representations? Because we need to have evidence as auditors when we are giving an opinion that we found these issues, we well communicated these issues to the management, and they are known parties about these issues and they didn't do anything. So that's why for our purposes, for auditors purposes, we take written representations. So document clearly trivial threshold, accumulated misstatements, and the conclusions reached. So sometimes when the material uncorrected misstatements are very important, we might tend to give a negative audit opinion, adverse audit opinion on the financial statements. We are saying the financial statements do not give a true and a fair representation. The materials, financial statements have not been prepared in all material respects. So we will give a negative opinion as like that when the total uncorrected material misstatements are material, right? So this is how the process goes. Basically, what you need to understand is we calculate materiality at the very beginning, and that is very important throughout the audit. So actually, I have uploaded a reading material for materiality. You can search and download the document as well, but I have uploaded this. This is one document issued by KPMG Indian office, but a very small summary. You can see 3-page summary. That's why I uploaded this. So it's like this. I'm not going to read, but it says what is materiality. You can have a quick look. What is materiality? It explains very well. And then how to determine materiality. That one I want to talk about. So determining materiality is a key judgmental area for an auditor. See, it's a judgmental area and it is determined at the time of planning. While the auditor should consider the needs of the users of an entity's financial statements when determining the appropriate benchmark, they should also consider nature of the entity and the industry in which it operates as a factors on which base their materiality calculation. Remember, company to company, the benchmark they use to calculate materiality would be different because of the industry and the nature of the company. Generally, profit before tax is considered to be the most important metric for any user of financial statements, and hence it is considered to be the most appropriate benchmark for determining materiality. Remember, mostly used benchmark is profit before tax, right? And then in many cases, materiality can be set in a range of 3 to 10% of PBT. See, we can't exactly say 3% of PBT should be the materiality. The standard doesn't, the standard is silent on that. We can't say 10% of PBT because it depends. So I can't say take 5% of PBT as your materiality. That depends, right? So it will go from 3% to 10% of PBT depending on various other factors like whether a company is listed or unlisted or industry is risky or not, whether financial covenants of the debt are sensitive to operate results. So what is the stability, what is the economic environment. Likewise, based on different factors, it's a professional judgment, right? And then again, this one is also important. In certain situations, PBT may not be considered as an appropriate benchmark to determine materiality. Sometimes PBT is not important. Not important in the sense that is not that relevant. These may be situations like when the users of the financial statements may not focus on PBT, and other metrics like revenue, total assets may be considered as benchmark to determine materiality, depending upon which metrics is most important to the users of financial statements. So sometimes some stakeholders they don't go after the profit before tax (PBT), they go after revenue or the total assets. So when the most important benchmark is revenue or total assets, we need to calculate materiality using those benchmarks. So different situations in which a benchmark other than PBT may be considered to determine materiality. So what are the examples? Investment funds or trust, where the presumed benchmark for determining material is likely to be total assets, not PBT, since the focus of the users would be on total assets considering the nature of the industry. Remember, this is one example. And maybe entities that trade mainly for capital gains, for example, investment property companies, the presumed benchmark is most likely to be total assets, since profit in such entities would be generated through increase in the value of the underlying assets. So these are just two examples. This is how the benchmarks can be different. I hope that's clear. You can read them. And then in addition to that, that is about the first page. And then when you have volatility in PBT, when your PBT is always getting changed, very volatile, then what is the most important benchmark? Likewise, you have different things. And determining performance materiality. I'm not going to read it. You can read this because I have explained performance materiality. So, how to determine the performance materiality and all. You have all these data. So basically, remember you need to understand the difference between materiality, performance materiality, what are the benchmarks we are going to use to calculate materiality, what are the qualitative factors to be considered, what are the auditor's judgments when considering materiality. Likewise, you need to have that overall understanding. Right. So if you have any questions regarding materiality, you can ask now before I go to the second lesson. Is everything clear? Right. So we'll start the next lesson as well. So today we are going to discuss our second topic, that is going concern. Another very important thing, but a short topic, I would say. ISA 570, going concern. So I think going concern is not a new concept or new thing to you guys, because as we have learned financial accounting, as we well aware of the financial statement preparation, LKAS1 presentation of financial statements. So we have discussed about this going concern, not in auditing, but at least when it comes to financial accounting, right? So going concern, you as students who have studied commerce, you start discussing this going concern, I think, from all levels and definitely in A levels. What is the singular term for going concern? What's the singular term for going concern? At least you can type in English. What do you mean by going concern? Yes, Akhanda Pavatma, right? Thank you. So when we prepare basically the financial statements, what is the main assumption? What is the main assumption we are going to use when we are preparing financial statements? That is going concern. So as auditors, when we are trying to audit the financial statements, going concern assumption, the use of the going concern assumptions when preparing those financial statements is very important. So as auditors, that is one of the main things we need to understand, whether this company has a going concern, whether the management of this company has used this assumption clearly, whether they can use this assumption or whether they can't use this assumption. Likewise, we need to be very clear about the going concern. And if they don't allowed, or let's say there are different situations saying that this company doesn't have a going concern, that this company can't operate for a foreseeable future. So if so, there are different things the auditor should do. So auditor should collect audit evidence with regards to going concern assumption. Auditor has to do so many work. And also, if the auditor finds out that there are some issues with regards to this going concern assumption, auditor has to report all these things in the audit report. So let's say if the company doesn't have going concern, but they have used going concern, in that case, even the auditor can give an adverse opinion. Adverse opinion says negative or audit opinion, that we are saying these financial statements do not give a true and a fair view, that these financial statements have not been prepared in all material respects. Likewise, we can go up to that level. So that is why going concern is one of the basic assumptions in accounting, but that is very important, right? Okay, so when it comes to going concern, when it comes to the introduction, what is going concern assumption? Basically, I'm not going to spend much time here. Under the going concern assumption, an entity is viewed as continuing its business for a foreseeable future. That is the meaning of going concern assumption. So basically, when we have two types of financial statements, no? General purpose financial statements and special purpose financial statements. So when we have general purpose financial statements, they are prepared on going concern basis unless management either intends to liquidate the entity or cease operations or has no realistic alternative but to do so. Let's say companies using going concern assumption. How are we going to present the assets and liabilities in the statement of financial position? If the company is using the assumption, if the company is assuming that the company will continue its business for a foreseeable future, in other words, it has a going concern, how are they going to present the assets and liabilities of the company in the statement of financial position? Basically, we give Very good. We classify our assets as current and non-current. We classify our liabilities as current and non-current liabilities. So that is how we basically show them. But let's say we don't have that going concern. Let's say we are going to liquidate the company. We are going to cease the operations of the company in after 7 months. That means for a next 12 months period, we don't have a going concern. So are we going to classify assets and liabilities as into current and non-current? No. All are current because we are going to settle all the liabilities within a shorter period, before 12 months period. We are going to realize all the assets within the shorter period, before 12 months period. So we are going to show all assets and all liabilities as current liabilities and current assets. So you know these things, right? So that is why sometimes organizations use going concern assumption. Sometimes, if they are trying to cease the operations or liquidate the entity, then they do not use going concern. And then, when it comes to special purpose financial statements, may or may not be prepared in accordance with the financial statement preparation. You know this, right? Because those financial statements are prepared for a special purpose, not for the general public, not general purpose financial statements. So it's not mandatory for them to follow a financial reporting framework for which the going concern basis is relevant. And then when the use of the going concern assumption is appropriate, assets and liabilities are recorded on the basis that the entity will be able to realize its assets and discharge its liabilities in the normal course of the business. Normal course of the business means not less than 12 months. Usually, we are expecting the business to continue for the foreseeable future. We are not expecting the business to be shut down within 12 months, right? And then when it comes to some examples, an oil and gas firm operating in Sri Lanka is stopped by a Sri Lankan court from carrying out operations in Sri Lanka. Think about the situation and don't read the answer. What do you think? Whether this oil and gas firm in Sri Lanka, does that company has going concern assumption? Can that company use going concern Assumption? No. Because there's a Sri Lankan court order saying, asking the company to stop the operations. The firm is not a going concern in Sri Lanka because it has to be shut down, right? Second example, a nationalized refinery is in cash flows problems, but the government of the country provided a guarantee to the refinery to help it out with all payments. So there are issues, there are poor financial position because there are cash flows problems. If the cash flow problems continue for the next couple of years, that means more than 12 months, definitely the company will not be able to survive. So that means there's no going concern. But the government is helping. Has provided a guarantee that we will settle all the payments and we will take care of the company. In that case, can this company can use going concern assumption? The refinery is a going concern despite poor financial position. Why? It has the support of the government. Third example. A bank is in serious financial troubles and the government is not willing to bail it out. The government support is not there. The board of directors has passed a resolution to liquidate the business. In that case, can the bank use going concern assumption? No, the bank is not a going concern. Right? These are the circumstances. Last one. Read this. The entity X is making continuous losses over the years, and as a result, its net assets are deteriorating with a net current liability position. That means basically, when we take the financial statement of financial position, we can take current assets and current liabilities. What is healthy? Always current assets should be higher than current liabilities. There should be a net current asset position. But let's say net assets are deteriorating. That means net assets are reducing and the current liabilities are increasing. So we have what kind of a situation? Net current liability situation, right? Current assets are lower than the current liabilities. The parent entity, now it has a parent, it seems entity has provided a letter of financial support that it will render all necessary financial assistance for the next 12 months to allow the entity X to continue in business without curtailing any of its major operations. Now, the company has a net current liability position. That means current assets are lower than the current liabilities, bad situation, poor financial situation. But the parent company is saying we will give all the financial support and it issues a letter of financial support. This is kind of a letter we will discuss. So in that case, what happens? Even though company X is in trouble, parent company is there to support. Can the company X, entity X, use going concern assumption? Entity X is a going concern despite its poor financial performance and the financial position because the support from the parent company is there. Right. So that is how basically we decide whether we can use going concern assumption or not. Now we are discussing responsibility for assessment of the entity's ability to continue as a going concern. Right. Now here, some financial reporting frameworks contain an explicit requirement for management to make a specific assessment of entities' ability to continue as a going concern. That means companies' management, the management of the company is required to do an assessment of the entity's ability to continue as a going concern. Remember, they are doing an assessment. They have to consider all internal and external factors which might affect the going concern of the company. And they need to assess, they need to calculate the cash flows, future cash flows of the organization, and they need to see whether the possible cash outflows or inflows, net assets, net liability situation. Likewise, they need to assess whether the company has a going concern issue or not. And standards regarding matters to be considered and disclosures to be made in connection with going concern. If there are going concern issues, what happens? They need to mention them in the annual report, in the financial state notes to the financial statements. That means they need to acknowledge the fact that they can't use going concern likewise. For example, Sri Lanka Accounting Standard LKS1 requires management to make an assessment of an entity's ability to continue as a going concern. So as per LKS1, management is required to do an assessment on the ability to continue as a going concern. So, management's assessment of entities' ability to continue as a going concern involves making a judgment. Basically, it's about the future. No, we can't exactly say the right thing, but it's always judgmental. Making a judgment at a particular point in time about inherently uncertain future outcomes of events or conditions. So basically, we are talking about different judgments when we do this assessment. What are the factors to consider? The degree of uncertainty associated with the outcomes of an event or condition increases significantly the further into the future an event or condition or the outcome occurs. So basically, we need to understand when we have a problem, when we have, let's say, company is currently having an issue with one of its major customers. Let's say 90% of the sales are going for one particular customer. that customer is having problems with the company. So when we try to understand whether our company has a going concern, because if we lose this customer, 90% of the sales are gone. It would be very difficult to recover that sales, lost revenue from different other parties. So in that case, we try to understand the uncertainty associated with this outcome. Sometimes we might have discussions currently going on with this customer. We are trying to negotiate with the customer and all. So uncertainty is there. So we are trying to understand the degree of uncertainty. And then the size and complexity of the entity, nature and conditions of its business, and the degree to which it is affected by external factors. What is the nature of the company? Now, in this case, now different external factors can be there. Different political factors, different natural factors, external environment factors can be there. Now, think about this global condition at this time also. There are different industries affected by the current situation, right? So in that case, because of these external factors, the companies might not be able to continue as a going concern. So that's why we are trying to understand the complexity of the nature, complexity of the condition. And any judgment about the future is based on information available at the time at which the judgment is made. Subsequent events may result in outcomes that are inconsistent with judgments that were reasonable at the time they were made. Because when we do this going concern assessment, we are doing this assessment basically based on the information available right now. Because but tomorrow, at this situation, global situation, tomorrow the things might change, isn't it? We don't know what will happen to Sri Lanka overnight. We don't know what will happen to any other country overnight. So in 1 week's time, in 1 month's time, information can be different, but we need to understand the fact that we do this assessment with the information we have right now, right? So that is how the responsibility is there to do the assessment on going concern. That is important. And then when it comes to LKS1, it says requires that when preparing financial statements, management shall make an assessment of the entity's ability to continue as a going concern. That is the first step, first important thing we were talking about. Remember that. An entity shall prepare financial statements on going concern basis unless management either intends to liquidate the entity or cease the operations. We discussed that fact as well. Companies can use going concern assumption if they are not going to stop the company operations. And another important thing, that assessment, we were saying going concern assessment should cover 12 months period from the end of financial period. Usually, we are talking about the next 12 months. When we do the assessment, we are not going to do the going concern assessment for the next 15 years. That is not practically possible at all. We don't know what will happen, but we are considering usually 12 months from the period end date. So when an entity does not prepare its financial statements on a going concern basis, it shall disclose the fact together with the basis on which it prepared. Let's say a company is not preparing financial statements based on the assumption of going concern. Then that the financial statements should disclose what is the basis they have used. Why haven't they ignored the going concern assumption? Why haven't they used the going concern assumption? The reason why the entity is not regarded as a going concern, they need to mention as per LKS 1 requirements. Okay, so that is about LKS 1. And then we are moving to auditor's side. Now we are auditors. We are going to audit the company. What is the objective of the auditor when it comes to this going concern assumption? We are trying to obtain sufficient, appropriate audit evidence regarding the appropriateness of the management's use of the going concern assumption. Now, the company has used going concern assumption when preparing financial statements. we go and check, we collect evidence regarding the appropriateness of the management's use, whether the management can actually use that assumption or not appropriateness. And to conclude, based on audit evidence obtained, whether a material uncertainty exists related to events or conditions. That is another concept actually. Going concern use of the going concern assumption is one story. And sometimes we say, even though the company has a going concern, even though the company's management can use the going concern assumption, sometimes companies are having material uncertainties. That means problems are there. They can use going concern assumption. That's all right. But there are some issues. There are some emerging issues, material uncertainties. So we are going to check first requirement as the auditor. First objective is to see whether it is appropriate for the company to use the going concern assumption. And then the second one is whether there are material misstatements, whether there are material uncertainties exist related to events or conditions that may cause significant doubt on entities' ability to continue as a going concern. Even though they can use going concern assumption, sometimes there are material uncertainties. So that is the second objective of the auditor. Remember, first one and the second one. And the third one is definitely to report in accordance with this ISA. Because based on the evidences we collect over the appropriateness of the going concern assumption use and then the material uncertainties on the going concern, we might change the audit report, right? So that is the third objective. There are three objectives as such. This responsibility exists even if the financial reporting framework used in the preparation of financial statements does not include an explicit requirement for a management to make specific assessment. Because now this doesn't apply to LKAS1 because LKAS1 exactly says that the management has to do the going concern assessment. Accordingly, the absence of any reference to a material uncertainty about the entity's ability to continue as a going concern in an auditor's report cannot be viewed as a guarantee as to the entity's ability to continue as a going concern. Very important. Let's say, as per the auditor's report, we say that we don't say anything about material uncertainties related to the going concern because we also do it on sample basis. It is judgmental. We are trying to understand the management's assessment they have done. We rely on their assessment as well after collecting some evidences. So when we report that in the auditor's report, that doesn't mean that the entity has a going concern, right? We can't exactly say like that. So the continue as a going concern in an audit report cannot be viewed as a guarantee. Anyone can't take this as a guarantee that saying this company has a going concern because the auditor's report is silent on that fact. Again, you can't exactly say because we are doing a sample based audit. Right. So, what are the requirements actually? What are the factors that reflect that there is a going concern issue or uncertainties? So, events and conditions that may cast doubt about going concern assumptions, individually or collectively, there are different factors. So, give me a second. You can read these factors, the financial factors which will affect, that will cast a doubt about the going concern assumption. You can list down. So, I will continue the lesson. Give me a second. Right. So when it comes to the financial requirements, The first one is net liability or net current liability position. So, as I mentioned earlier, we can understand that there's a problem, that there is a significant doubt over the going concern assumption when we see net liability position. That means assets are lower than the liabilities. Or net current liability position. That means current liabilities are greater than the current assets. So it's an indication. These are indications actually. It's an indication that there can be a problem on going concern assumption. And then fixed term borrowings approaching maturity without realistic prospects of renewal or repayment. Because we have taken a very big loan, and that maturity is coming, that is very closer, but we don't have a renewal or repayment plan, or excessive reliance on short term borrowings to finance long term assets. We have obtained long term assets, that means PPEs through short term borrowings. That's a problem again. Indications of withdrawal of financial support by creditors, another indication. If we have negative operating cash flows, that means possible cash outflows are higher than the inflows. Adverse key financial ratios, when we calculate the ratios, investment ratios, profit ratios, and all these liquidity ratios, equity ratios, adverse ratios can be there. Another indication. Substantial operating losses or significant deterioration in the value of assets. Arrears or discontinuation of dividends. Inability to pay creditors on due dates. Inability to comply with the terms of loan agreements. Change from credit to cash on delivery transactions with suppliers. Inability to obtain financing for essential new product developments and other investments. So basically, different financial indicators saying that there can be going concern assumption issues. So individually or collectively, some points individually they are very material. If we take net liability or net current liability position, individually material to say that there's a problem. Some collectively, when we take these indicators together, it says that there is a problem. And then look at operating issues. These are financial. Operating issues also can be there. Management intentions to liquidate the entity or to cease operations. Loss of key management without replacement, or the top layer is going. Loss of major markets, key customers. Labor difficulties are there. Important supply shortages are there. Emergence of highly successful competitor. That means we are going to lose our market operating conditions. And then what are the other indicators? Maybe non-compliance with capital or other statutory requirement. We are having a huge dispute with a prevailing law. So we know there will be problem in future. Pending legal or regulatory proceedings against the company. And that may, if successful, result in claims that the entity is unlikely to be able to satisfy. Most of the time, the tendency of winning the court case is at a very low level. Maybe changes in laws and regulations, that the government is going to issue a circular saying this kind of nature businesses are prohibited in Sri Lanka. They can't, let's say we are importing milk powder and selling in Sri Lanka. Government is trying to get a new law saying any company can't import milk powder to Sri Lanka. So in that case, there's a change in law and regulation. It's a other factor, other indicator saying that there's a going concern assumption. And uninsured or underinsured catastrophes when they occur. Maybe natural disasters are there. So those are the indicators saying that there are problems with going concern. And then evaluating management's assessment. Now I told you, as per case 1, we need to evaluate, we need to assess the going concern assumption use of the company. Management has to do that assessment. Now, as auditors, we need to evaluate that management's assessment. Not that auditors are doing that going concern assessment. Management has to do that going concern assessment. Auditors are evaluating that assessment done by the management. So auditor has a responsibility to evaluate whether there is a substantial doubt about entity's ability to continue as a going concern for a reasonable period of time. At least 1 year, that is the standard time period, beyond the date of the financial statements being audited. So, what are the steps in this going concern evaluation? Consider if the results of all audit procedures performed during the audit indicate whether there is substantial doubt about entities' ability to continue as a going concern. Now, when we do this, throughout the audit, when we collect audit evidences, when we inquire people, when we investigate different factors, from different aspects, we might collect the audit evidences. And it's getting realized that, okay, we have a problem here as well. When it comes to PP also, we have a problem. When it comes to loans and borrowings also, we have a problem. When we take all these evidences together, it seems that there's a problem of going concern, right? That is the first thing. And if there is a substantial doubt, now we have a doubt, the auditor should obtain information about management's plan to mitigate the going concern problems. Now we need to ask, let's say we have net operating negative operating cash flows, we have net liability positions coming, ratios are not healthy, we have problems with the customers and all. Now we are asking the management whether they have plans to solve these going concern problems. Let's say the company, if the company has a parent company, if that parent company is giving the financial support, then their going concern issue will be solved up to some extent. So we are asking whether they have any mitigating things. Assess the likelihood that such plans can be implemented. Now, with my experience, when we ask the management whether they have different plans to mitigate the issue, they have so many solutions. They have plans, but some they can't implement actually. So that is why we need to understand the likelihood that such plans can be implemented as well. So practical solutions can be there, should be there. And then, if the auditor concludes after evaluating management plans that the entity has a going concern problem, auditor should consider implications to the auditor's report. Now, after all, so we collected audit evidences, we inquired the management about their plans and their practical aspects, and then even after doing all these things, if the auditor concludes that, okay, now this company has an issue with going concern, auditor should consider this implication on the auditor's report. And then another important thing, when we as auditors evaluate this going concern assumption, management did the assessment for 12 months period. No, we have to cover the same period. So shall cover the same period as that used by management to make it assessment. If management assessment of entities' ability to continue as a going concern covers less than 12 months, what happens? That means they have done the assessment for 6 months, maybe. Auditor shall request management to extend its assessment period to at least 12 months from that date. So the minimum period is 12 months. It can't be 6 months or 7 months. So we ask the management to extend the period they have considered for the assessment. In evaluating management's assessment, the auditor shall consider whether management's assessment includes all relevant information of which the auditor is aware as a result of the audit, whether they have considered everything. Let's say the management has done a going concern assessment, but they have not considered the important aspects. But we as auditors, we became aware of creditor issues, debtor issues, customer issues, any operating issues and all. But they have not considered any. The auditor shall evaluate the process management followed to make its assessment. So we check whether what is the process they have followed, the assumptions on which the assessment is based, and the management's plan for future actions, and whether management plans are feasible, whether they have practical, feasible plans to uh, uh, solve these going concern issues. Right. And then we can understand what are the auditing procedures the audit team could perform in assessing whether entity is a going concern or not. So basically, when understanding whether the going concern assumption usage of going concern assumption is appropriate or not, what are the audit procedures we can do. So I'm not going to explain everything, but we'll read few audit procedures. Obtain future years budgets and cash flow forecasts for next financial year approved by the board of directors or an equivalent authority. So through the cash flow forecast for the next year, we will be able to collect audit evidence on the cash inflows and outflows and try to see whether they have positive operating cash flows. Assess the assumptions for reasonableness and discuss findings with the management to understand whether budgets and the cash flow forecast are realistic. If there are problems, you can ask the management. Perform sensitivity analysis on budgets and cash flow forecast, because if they have used 10% interest rate to be applicable for the next year, what if that interest becomes 12%? So you can do a sensitivity analysis kind of thing. If the ratios they have used becomes this, what will happen? So likewise, we don't know the assumptions they have used. So we need to understand the assumptions they have used, the reasonableness of their assumptions, and also the sensitivity analysis, and obtain the restructuring plan if any. If the company has a restructuring plan, if something goes wrong, you can ask for that, obtain that plan, if any, approved by the board of directors to review how restructuring would contribute to generative positive results. Sometimes the organizations do have this restructuring plan. If something goes wrong, what is our plan? And then review the post-year end revenue and confirmed orders for the future period. Sometimes year end they have so many advances or the sales orders are there. So you're going to see whether they are going to be actually realized in the next year. Review the current loan agreements and correspondences with banks to determine whether covenants have been breached. So if the company has breached the loan covenants, there will be significant issues in the near future. So you are going to collect all these loan agreements and discuss with the banks and try to understand whether there are any issues or breach of loan covenants done by the client. And then you can see obtain a copy of the letter of financial support provided by the parent company. Let's say this is a subsidiary company. Parent company is there. Parent company has issued a letter saying if this subsidiary is having issues, financial issues, that they will support, that they will give money. So we call that letter of financial support. So we need to understand whether that letter is there. Obtain a copy, evaluate whether that is a true letter or not, likewise, and inquire of legal representatives. You can call lawyers and ask. Perform audit tests in relation to subsequent events to identify any terms which might indicate or mitigate the risk of going concern. Review the post year end board meetings. Now, when you read the board meeting minutes, you can understand whether there are problems discussed during the meetings, whether there are issues. So, likewise, you are going to review the meeting minutes as well. Likewise, I'm not going to explain all. You can read and understand. There are so many audit procedures we can do apart from collecting audit evidences on revenue, PPE, all these transactions and balances, separately we can perform these audit procedures just to check the appropriateness of the use of going concern assumption, right? Okay. Now, auditors' conclusions. Now, we have collected audit evidences. We are going to see whether they have problems with the going concern. And then we are trying to conclude the appropriateness of the company to use the going concern assumption. So the auditor shall evaluate whether sufficient appropriate audit evidence has been obtained regarding and shall conclude on the appropriateness of management's use of the going concern basis. Based on the audit evidence obtained, the auditor shall conclude whether in the auditor's judgment, remember it's a judgment, management is also judgmental, auditor is also using judgments. A material uncertainty exists related to events and conditions. If you can remember, there were three objectives. No? The first objective is evaluating the appropriateness of the use of going concern assumption. Second one is auditor need to understand whether there are material uncertainties with regards to going concern. So that is why it says a material uncertainty exists related to the events or conditions that individually or collectively may cast significant doubt on entities' ability to continue as a going concern. That there are issues. A material uncertainty exists when the magnitude of its potential impact and likelihood of occurrence is such that, in the auditor's judgment, appropriate disclosure of the nature and implications of the uncertainty is necessary. Now, the auditor will decide, let's say we identify that there is a material uncertainty, that there will be a problem like this. There are current negotiations with the customer because the major customer is not happy with the client, our company. So in that case, there are material uncertainties about the going concern. And you need to understand the potential impact. The first important thing, if the customer disagrees with our proposals, if the customer is very unhappy about the company, if the customer is going, if the company is, if the customer is canceling the agreement with the company, what is the potential impact? Let's say 90% of the sales are from that customer, then it's a huge impact on our profitability. So the potential impact and the likelihood. Sometimes, even though the impact is very huge, the likelihood of happening that issue, the likelihood of canceling that agreement by that customer, it can be low or high. So we need to analyze that, the potential impact and the likelihood of occurrence. So based on those two factors, we try to understand using our judgments whether there is a material uncertainty. If there is a material uncertainty, what will happen? Definitely that should be disclosed. Definitely the implications, the nature of that uncertainty should be disclosed in the financial statements. So basically, what is this material uncertainty? A material uncertainty is one relating to events or conditions that may cast significant doubt on the entity's ability to continue as a going concern. And that may therefore indicate that it may be unable to realize its assets and discharge its liabilities in the normal course of the business. So it won't be able to conduct its normal operations in the normal course of the business. Definitely there are issues. That is the material uncertainty. So I'm talking about the implications now. So let's say we'll take scenario wise. Use of going concern basis of accounting is inappropriate. Let's say based on the evidences, we find out as auditors, okay, they can't use this going concern assumption. It is inappropriate. So if the financial statements have been prepared using going concern basis of accounting, but in the auditor's judgment, management's use of the going concern basis of accounting in the preparation of financial statements is inappropriate. Let's say they have used going concern assumption, but as auditors, we say, no, they can't use going concern assumption. They don't have a going concern. Now, what is that? What is the implication on the audit report? Auditor shall express an adverse opinion regardless of whether or not the financial statements include disclosures of the inappropriateness of management's use of the going concern. They can have disclosures as well, but that doesn't matter at all. If they have used going concern assumptions, but it is not appropriate, we will have to issue an adverse opinion. So that is the first thing, remember. Let's say if financial statements are prepared on another basis, that means going concern assumption is not suitable because they are going to liquidate the company. So that is why they can't use going concern assumption. So they have not used going concern. They have presented all the assets and liabilities as current assets and current liabilities. Then what? They are right? They are okay. Then the auditor may be able to express an unmodified opinion. Unmodified means positive, no issues. Unmodified opinion on those financial statements, provided there is adequate disclosure therein about the basis of accounting. Remember, if they have not used going concern assumption, then they have disclosed what is the basis they have used, why they have used. So there should be adequate disclosure. So let's say company X, they don't have going concern, they know it, they have not used it. So they have used liquidity basis for the preparation of financial statements, and they have mentioned that in the disclosures as well. No problem then. So auditor is fine giving an unmodified opinion. Sometimes auditor will consider that it's better to include an emphasis of matter paragraph in the audit report. I hope you are not aware of this emphasis of matter paragraph yet, because we will be discussing about these paragraphs in the audit report lesson. So you will learn there are different paragraphs to be included. Emphasis of matter paragraph, other matter paragraph as such. Emphasis of matter paragraph means if the auditor wants to emphasize something that has been already recorded in the financial statements in the audit report, auditor is using emphasis of meta paragraph. So in that paragraph, auditor is simply saying, as per the note number this given in the financial statements, client, this company has disclosed this. Auditor just wants to emphasize that fact in the audit report. Already disclosed, perfectly fine. Auditor wants to emphasize that matter to the readers. So here, company has not used going concern assumption. They have done it correctly with another basis, and they have disclosed it as well. So if the auditor thinks that it is important for the readers to know that this company has not used going concern but another basis, they can use an emphasis of matter paragraph as well, right? That is the implication. Next one. Adequacy of disclosures when events or conditions have been identified and a material uncertainty exists. Now, here we were not talking about material uncertainty. Now, if we have some material uncertainties as we discussed, let's say if the auditor concludes that management's use of the going concern basis of accounting is appropriate, that means they can actually use the going concern assumption. They don't have to avoid it. They can use appropriate in the circumstances, but a material uncertainty exists. They can use going concern assumption, but there are issues. There are material uncertainties. Now, what will happen? The auditor shall determine whether the financial statements adequately disclose the principal events or conditions that may cast significant doubt on entities' ability to continue as a going concern, and management's plan to deal with these events. Now, if the client has used going concern assumption, but the auditors identify that there are material uncertainties, now the auditor is checking whether this client has disclosed those material uncertainties in the financial statements with their plans to deal with these conditions, and disclose clearly that there is a material uncertainty related to events or conditions that may cause significant doubts on the ability to continue as a going concern. Therefore, it may be unable to realize its assets and discharge its liabilities in the normal course of business. That means if they have identified material uncertainties, basically auditor is checking whether the client has disclosed. Whether the client has disclosed that there are material uncertainties which may cause significant doubt on entities going concern. Now the point is, if adequate disclosure of a material uncertainty is made in the financial statement. So this is the requirement. If there are material uncertainties, definitely it should be adequately disclosed. Now the scenario is, let's say adequate disclosures are there. Client has disclosed everything. If adequate disclosure about the material uncertainty is made in the financial statements, now what's the issue? The auditor shall express an unmodified opinion. No issue. They can use going concern assumption, that's fine, but they have material uncertainties, so they have disclosed that fact as well. No need to modify the opinion. They can issue, auditor can issue an unmodified opinion. And very important, the auditor's report shall include a separate section under the heading Material Uncertainty Related to Going Concern. That means they are issuing an unmodified opinion. They are not qualifying, they are not giving an adverse opinion. But auditor will include a separate paragraph, separate section in the auditor's report with the subtopic material uncertainty related to going concern. That means auditor wants to emphasize that there's a problem and they are well aware of the issue. So they talk about that issue in the audit report. So what is the purpose? To draw attention to the note in the financial statements that discloses the relevant matters. So it's kind of an emphasis of meta paragraph. Previously I told you emphasis of meta paragraph, but we don't say this emphasis of meta paragraph. Since this is very, very important, we use a separate paragraph to discuss this fact. So we say, as mentioned or as disclosed in note number this by the client, by the company, this company is having material uncertainties related to the going concern. We just want your attention here. So that is a separate, this is a unique paragraph, I would say, only for the going concern issues. State that these events or conditions indicate that a material uncertainty exists that may cast significant doubt on entities' ability to continue as a going concern, and that auditor's opinion is not modified. We didn't modify the audit opinion because client has done the correct thing. They have disclosed everything. They can use going concern assumption, but there are material uncertainties. So that is how auditor reacts when there are adequate disclosures. Let's say the opposite of it. Adequate disclosures of material uncertainty is not made in the financial statements. Now, no disclosures. Auditor shall express a qualified opinion. So, again, I'm saying you will learn these opinions later. Qualified opinion. Let's say we are saying the financial statements disclosures are inadequate, so we qualify audit opinion. And we can give an adverse opinion. Qualified opinion is like adverse opinion is saying directly saying that these financial statements do not give a true and a fair view. That's very bad. Complete opposite of the unmodified opinion. Complete opposite of the clean opinion. Adverse. Qualified means only for this section, the financial statements do not give a true and a fair view. Other than that, all are fine. That kind of a situation. You will learn these things. But remember, auditor can give qualified opinion or an adverse opinion. So, as required by this ISA, when the auditor has obtained sufficient appropriate audit evidence regarding the appropriateness of the management's use of the going concern basis, but adequate disclosures of the material uncertainty is not made in the financial statements, the auditor has to first assess whether effects on the financial statements of the inadequate disclosures are likely to be material but unlikely to be having pervasive effect on the financial statements. So it will likely to have both material and pervasive effect. That is, they are to decide whether it is a qualified or adverse opinion. Let's say they have used going concern assumption, that's okay, but they have material uncertainties, but they have not disclosed. Let's say that will affect the whole set of financial statements, that will affect the profitability, that will affect the assets. Whole set of financial statements are misleading because without that disclosure, if it has a bigger effect like that, then you will give adverse opinion. Let's say because of that issue, our PPE will be misstated. Our PPE will be at risk. Other captions are fine. Then kind of you will give qualified opinion. So you will, when you learn these opinions, two opinions, then you will realize the depth of this, right? That is how you do it. And then finally, how to communicate with those charged with governance. That means the top management. Auditors shall communicate with those charged with governance. You call them those charged with governance. The short abbreviation is TCWG. Those charged with governance. That is for your information. Events or conditions identified that may cause significant doubt as a going concern. Maybe whether the events or conditions constitute a material uncertainty, we need to communicate them. Whether the use of going concern assumption is appropriate, we need to communicate. The adequacy of the disclosures and the implications of the auditor's report, that we need to inform them that we are going to qualify the audit opinion. We need to inform them that we are going to give an adverse opinion. Likewise, then only they will react to these situations. So likewise, we need to communicate them as well. Right. So those are the important things we have to understand when it comes to going concern. Do you have any issues? Any clarifications to be made? You can ask. You can use chat box as well. Right. Okay. Okay. So with that, we can actually wind up the session. Uh, Give me a second. I will share the OTP. You can mark your attendance. I know the count that there are only 23 students, so please don't mark for others. You can log into your exam LMS accounts and then wait for the OTP. Not exam LMS, exam unit. Right. Your OTP I will share. 579679. Right. Have you marked your attendance? Done? Right. Okay. So with that, I can wind up the session today's one. And if there are, I think there is a cover up session as well because of the replacement dates. So we will inform those dates and when to have the lectures, what is the mode, physical, online, all these things. So until that, good night, Ramai. Have a nice week.